Good morning, this is Larry Edelson for my Uncommon Wisdom video for Thursday, March 18th. The big news so far this week was this past Tuesday's Federal Reserve meeting, the Federal Open Market Committee or FOMC meeting, where Ben Bernanke made it clear that he's not going to be raising rates anytime soon, and he even left in the press release that was announced after the meeting that rates could stay low for an extended period of time. This should not be any surprise to any of you following my work. I have told you many times that Big Ben is going to keep rates as low as far as the eye can see. He's an easy money policy type central banker, especially in the face of the financial crisis. He will continue to do whatever he can to keep the cost of money and credit low for as long as possible, and he will print money for as long as possible. I just put my Real Wealth March issue to bed. It will be going to press this Friday, and in it I have a couple of charts that show how money growth through printing of fiat money is exploding again through the roof, and how banks are cashing in on this. And also an interesting chart I have in my Real Wealth that shows that banks are beginning to lend again, and that's a good sign for the economy. It is inflationary. The economy is definitely in better shape than it was a year ago or 2 years ago, but the economy is not going to be the same for many, many years, perhaps even 5 years. That does not mean, however, that we cannot see monetization of assets occur, which is inflation of assets, paper assets, and especially tangible assets like gold and oil, which we are already beginning to see. I want to go right to the gold chart, which I have right in front. Last week I talked about how we would see a test of support in this dashed horizontal line. That's exactly what happened. Then gold has recently, in the last 3 trading days, sprung right back up to above the 1128 area that I identified for you as important resistance. This is not yet a move that we want to take aggressive gold positions in. You should continue to hold your core gold positions that I've recommended. But for speculative positions, I still want to see a close above 1160, the top of this horizontal line. Remember, trading is a game of, for speculation, is a game of probabilities. And the probability of gold going to its next major target of $1,300 and even $1,500 an ounce increases substantially once we get a close above 1160. Until then, you're still kind of in between 1160 and 1100 as a trading range. Even though I'm waiting for a breakout above 1160 before getting aggressively long, that's a much higher probability trade than trying to buy here in anticipation of a move to above 1160 and ultimately 1300, 1500, and of course a couple years down the road 2200 plus. The dollar, we'll switch over here. This is the dollar index chart. We've switched to a new contract here, so I haven't updated my lines for you, but if you've been following along, this is the area here that I said dollar index would top and start to trade lower. That's clearly what's happening here. Let me quickly draw in a very simple trend line for you. You can see that the dollar index fell below the uptrend line that began in December of last year. That's a sign of the overall long-term weakness for the dollar. Despite the plunge that we saw in the euro, despite the plunge that we saw in the British pound, the dollar really did not gain that much throughout this time. This uptrend here looks pretty big on this chart, but it's really only about a 7-8% move off the lows of last December, which were very close to the record lows for the dollar. Very feeble rally in the dollar. I would not be surprised if the top of this rally is in and the dollar begins to trade substantially lower. It's a little too soon to say. The European crisis has temporarily gone away because Europe is bailing out Greece, but that's just kicking the can down the road. It will come back. It will impact Europe. We will see a collapse of the European monetary regime. and then a collapse in the U.S. dollar. We are witnessing the collapse of fiat money, a monetary crisis that we haven't seen since at least the 1930s, when we also had a monetary crisis that ultimately led to the dollar being devalued via an increase in the price of gold at that time. Dow, let's go to the Dow chart. Pretty much right on track here from what I've been telling you. Pull this down for you a little bit more. You can see the top here. I've got a lot of lines on these charts. The most important ones are the ones right in here. You can see we came back up, held this channel, and last week I told you where two lines intersect tend to act as a magnet in technical terms for price action. And lo and behold, the Dow is rallying towards this intersection of this uptrend line and the uppermost line of this intermediate trend channel here. That stands at just about precisely 10,765. If we sneak a little higher, we could get to 10.8. That is an area of major resistance. If the Dow breaks through the upside of that, we could see it move to 11 and as high as 11.6. I do not see the Dow moving any higher than 11.6 at this point in time if this cycle extends. The next major trend would then be a move down towards 9,000. So I would not be an aggressive stock buyer here other than for natural resources and mining shares. I would be looking for an interim top soon in the Dow and to trade the short side via perhaps inverse ETFs or put options for speculative gains. Long term, the Dow is probably in a neutral to bullish mode. Anyone who's followed my work knows that I expect radical new highs in stocks in 2015. For the next couple of years, we could be seeing wild swings between, let's say, 12,000 and 9,000 on the Dow, and then ultimately breaking out to the upside as the dollar collapses, and where we could see 15, 22, perhaps even as high as 40,000 on the Dow. And that would be under a hyperinflationary scenario where mostly blue chip stocks and blue chip tech stocks begin to take on the monetary attributes of a safe haven, with large multinational, international companies being considered far safer than bonds. Let's not forget that the big disaster that's occurring has moved into the bond sector and the sovereign debt sector. And as far as capital goes, there's 10, 12 times as much money and capital invested in the bond markets around the world than there is in the stock markets. So even if, let's say, 10 or 20% of the money in the bond markets around the world liquidates and goes into natural resources, gold, oil, natural resource stocks, blue chip tech stocks, you're talking about tens of trillions of dollars that could go into the stock market, pushing it much higher, and the stock market actually becoming kind of a safe haven in certain areas for wealth. This is a radical view, but it's not an unprecedented event. This is what happened in the early 30s, from 32 to 37. We saw a massive move to the upside in stock markets all over the world as the dollar was devalued. So you need to stay in tune. You need to think dynamically and differently these days, because although cycles repeat themselves, history repeats themselves, they never do so exactly the same way. Lightning does strike twice, but it strikes twice differently and in different places. Having said that, till next week, this is Larry. Have a good